What are the pros and cons of infinite banking? Let's go into that right now. Okay, this infinite banking concept, is it real? I mean, is it like a great way to build wealth? Or is it just like another little crappy sales pitch to get you to buy something that's a total ripoff? I want to dig into the good, the bad, and the ugly about infinite banking concept right now. All right, so let's talk about the infinite banking concept. If you have not heard of this before, I recommend checking out Nelson Nash's book, Becoming Your Own Banker. That book does cover a lot of the different things about how to use whole life insurance, like that life insurance policy, using it also as a tax-free high yield savings account to then use it to help you essentially become your own bank. And what they often will teach you is you can go and use it to buy cars or buy a house. And instead of going into debt, use that cash instead, but you can actually borrow from the insurance company, use that money and then pay yourself back is what they'll always tell you. But I mean, when you talk about this concept, there are a lot of little myths or little lies, even for that matter, that are taught about this that you gotta be aware of. And so again, I'm a big fan of the infinite banking concept, right? And a shout out to the Nelson Nash Institute for creating that and being a part of it because it was my start. I first learned about this actually about 20 years ago. Right at the time when I was quitting and being a financial advisor, I started hearing from all these real estate investors that you should do infinite banking. I was like, great, what is it? I've never heard of that before. And I'm a financial advisor, like, is this something that's with a bank? Like, no. You use whole life insurance. I'm like, what? That's like the worst insurance you could possibly use. It's expensive, it's a ripoff. I didn't know that for a fact. I just knew that because that was my opinion based on what other financial advisors taught me. Because we were like anti-whole life insurance. So anyways, long story short, I eventually drank the Kool-Aid, I read the book, and I got to know the concept. I said, okay, cool, it sounds good, but more importantly, it seems like these guys will love it. So maybe there's something to it that I'll understand later. Well, 2 years later into it, after I'd already become financially free, then the recession hit. My business was getting affected, the real estate was getting affected, I was getting hit from all different directions. I didn't have the cash to keep paying into it. And so eventually I lost the policy. Why? Because it was expensive. I was paying $1,000 a month for almost really over 2 years. I paid about 25 grand into it. And when I couldn't keep paying $1,000 a month, I lost the policy. It was like the biggest ripoff, almost like term insurance that I ever had. And it's not because it couldn't have been done better, because I asked the agent that I bought it from, I said, is there a way to make this better, make it cheaper, make it to where I can make more money with it? And he said, no. He said, nope, you can't do that. You'll break it, you'll get taxed. And I said, I hate taxes, so let's not do it. Well, I found out later he lied. And I confronted him about it. I said, hey, I realized you could actually pull different levers. Because I understand, guys, I had an insurance license. I've had an insurance license now for 23 years. So I had a license. I went and did my own research. I went and did my own things, found out if you pull different levers, you can make it cheaper. And then, of course, be able to grow that cash faster and make more money with it. Well, when I confronted him about it, he finally just said, Chris, I did it that way because I couldn't afford to cut my commissions. And I said, there's the real issue. All right, so let's talk about this because there are some good things and there's some bad things too. And I'll tell you, again, I'm a fan. I am now because I know you can do it differently, but it's not just about the product or the tool, right? Or even the concept. It's more about how the insurance agent sets it up for you. So I want to really dive into that a little bit more. Number one of the biggest myths, the cons I see with this, and this is the con that really is legitimately true. And this is why even Dave Ramsey rips on it and a lot of other people rip on it in the media, is because they say it's quote unquote expensive. And they're right. If you buy a traditional whole life policy, it is expensive. It's all front loaded. So think about it this way. Term insurance, we know that's like death insurance, right? Where whole life has this death insurance and it has this tax-free savings account inside of it. You pay extra because you're paying for both. Some people will confuse this. They'll say, well, really, you're just buying death benefit. You don't get any of that money when you die. Well, no, they're partly right, partly wrong. There are different things that are true and not true here. But what happens though is that because people buy the traditional whole life plan, whole life, unlike term, where term gets more expensive over time, whole life starts out expensive, then drops their costs as time goes on. So it's front loaded with those costs and then it gets cheaper. Think of it kind of like renting. When you rent, it might be cheaper up front, but each and every year they raise the rent on you, you have to pay more and more money. But when you own a home, it might be more expensive up front, but when you lock in that 30-year mortgage, right, when it's locked in, not only does your payment stay the same, but more and more goes to paying down the principal. So less and less goes to interest, more and more to principal. It's very similar with whole life. In the beginning, more goes to pay those insurance costs, and then as time goes on, as those costs lower and the cash in that tax-free savings account grows, that cash value as they call it, as it grows more and more, what happens is that it starts to build to the point where eventually the interest you're earning is actually paying for those insurance expenses and even making more of a gain. You actually make more money. And so that's where it's different. So it is expensive up front. Remember, I bought one that all of the costs were going in up front, all of it. And that's what traditional whole life looks like. Those first 2 years, usually every single dollar you pay in goes to paying for the death benefit, which also pays the agent's commissions. After that, then more and more goes paying towards that cash value, that tax-free savings account. That's the issue, right? I actually saw somebody, they sent me some numbers, and this is with a company I use. They said, hey, can you look at this? Because I know you write with this company, because we are insurance licensed. We do infinite banking, specifically what we call max ROI infinite banking inside our company. And so he sent me the numbers, and this woman was paying in $60,000 a year, $5,000 a month she's paying into this plan. Year one, she pays $60,000, zero in that cash account. Year two, pays $60,000, zero still in that cash account. That means she paid $120,000 and all of it went to paying for the insurance costs and the commissions. Year three, she pays another $60,000, so $180,000 total, and she finally has $30,000, right? Now I showed him the difference of what mine is. Same company, but what we do is we reduce the cost, we reduce the death benefit a little bit and everything else so that more cash goes in. Showed him that first year, it wasn't zero after paying $60,000, it was $50,000. So yes, there's still like $9,000 or so that came out in insurance costs, but now she has $50,000 from day one. Year two, it's well over like $100,000. By year three, after you paid in $180,000, that same amount she would have paid in ours, guess what? We'd actually have about $160,000 in there. And so way more cash than what she would have had having $30,000 instead, paying into that other plan. And by the way, by year five, she had more than $300,000, where in the other one, she had only like $100 and some odd thousand bucks. That's the difference. You can actually pull different levers and do it to where you can make it cheaper. Yeah, you'll still have insurance costs coming out. That's the part that is the negative, but it grows more. Going on off that negative, a lot of people that look at this look at it as only like, do I use savings to invest or do I use this? The problem is they look at it saying, well, look, I have those net costs. Wouldn't I just be better just investing all of my money versus losing some of it to those costs? Well, I say, well, yeah, of course. But remember, even if you buy term, invest the difference, eventually buy term will be more expensive than even using whole life. That's a guarantee. If you ever talk to like a guy like Tom Wheelwright, who is the CPA for the Rich Dad, Poor Dad books, right? Tom Wheelwright says that term insurance is an expense while whole life insurance is an asset because it does build that cash. It does grow by more, not just the death benefit, but also more than what you pay into it. But it does take some time. So the negative would be is that yes, you have upfront costs, especially in those first 2 years. After year three, it gets better. And that's why I usually with ours, rather than waiting 13 to 17 years to finally break even, ours do it in about 5, right? Because we reduce those costs. So there are ways to minimize those risks. The other second thing that I think is a con with it too is that a lot of people try to use this as a bill pay account. They try to put all their money in, right? And they're like, oh, I'm just gonna put all my money in and pull it out. A few problems with this. One, insurance companies, if they realize you're putting all your income into this, they will say no. They will not let you do it. Two, the thing is, I don't believe you should be putting all your money into it. That's my personal opinion. I think you should keep some money in cash. Some money goes in here, some money goes in there, but don't throw all your money in. Because people are trying to use this like a bill pay account and they say, well, I regain interest, I recapture dollars, lost dollars by doing this. I've done the math. As even looking at it from the lens of somebody who wants it to work, and I will tell you this, it's not worth the pain and effort. So when they try to tell you, oh, you just use this to pay your bills every single month, you just pull out of it every month and do this and that, the work that's involved is not worth the savings. Just not worth it. Here's the other thing too. You hear the myth saying, oh, you can buy cars with this, buy houses and things like that. That's true, you can. But here's the problem that many people say. They say, when you borrow from the insurance company, you pay yourself back. That is a lie. You do not pay yourself back. You are paying interest back to the insurance company, just as if you got a bank loan. So either way, you still have a loan. Now this loan is better because when you do borrow from the bank or from the insurance company, if you're using your life insurance as collateral, they use the cash in there as collateral and they'll give you a loan with their money. And so when they tell you like, yeah, you're paying yourself back, what they're really saying is whatever you would have paid to a bank payment, instead pay back to the insurance company, which will, yes, pay down your line of credit, which will free up the cash to do it again. So yes, that money does go back when you pay principal, but when you're paying interest, the interest does go to the insurance company or to the bank. The nice thing is with the insurance company, they don't require monthly payments. That is a good given. And so for some people, they're saying, you know what, I just don't want to have that worry about whether I can make the monthly payment or not. That's another debate about why they're in a situation where they might have to make that monthly payment and why that's a stress. But they say, I just don't want to worry about it, so I'm just going to do it this way. Great, that works great. They do still charge you interest, and the interest can compound against you, but the good news is they don't charge you a monthly fee or like a monthly payment. You pay it back however, whenever you want. The deadline for paying back those loans is your death. And at that point, what they do is they just take it from the death benefit that comes out, whatever loans you owe them, and then they pay the rest of your family tax-free. So those are kind of the cons that I hear about all the time. Is like using it like a bill pay account, using it to buy cars or houses. By the way, my personal opinion is if I can get the same or roughly about the better interest rate with the bank, I will use the bank's money all day long. I will borrow from the bank because that's their money, and I'll keep my cash for money that the bank won't give me money for. So if I want to put a down payment on a house, banks won't give me money for a down payment. They'll fund up to maybe 75 or 80% of the mortgage, but I have to come in with the rest of my cash. Then I'll use my life insurance to go and make that down payment. If I want to invest in another deal, maybe I'm lending my money. I did this with a guy before where, I was taking that money, I borrowed $50,000 for my policy, used it to give to a guy that I lent the money to him. He was paying me 15% a year. So I was making interest from him. Now I used that interest and that stuff to help pay down that loan and pay off the interest that was owed as well, and paid it all off, but I still made a good net gain without using any of my own actual cash, which was maybe tied up in other real estate deals. So there's a lot of different things you can do with it, but just understand that there are a lot of myths. Now that's the cons, right? Now the pros of it is it's liquid. It's money that when it's set up right, especially if you can reduce those costs, you have money available from day one. One of the myths is you have to wait 5 years, 3 years, whatever it might be. That's only because they're charging you so much in fees that there's no money to pull out. With ours, it's different. Ours is actually available from day one. So that $50,000 I mentioned, she can access about 95% of that from day one. So you get that liquidity benefit. This is why I tell people, use your emergency fund money, start moving it into here. It's almost like when people move money from a bank to a high yield savings account, same thing, but now we're going to a tax-free high yield savings account that right now is paying 6% a year. So huge, huge benefits. Also, another pro too is that it's not only just liquid, but I can use it for whatever I want. Understand that when the government sets up plans like IRAs and 401ks, you can only use it for one thing, retirement. And you gotta wait till you're 59 and a half, they'll slap you with penalties. Or if you have a 529 college savings plan, you can only use it for college, use it for anything else, penalty, right? They slap you with penalty. They just punish you left and right. They're like, you can only do one thing, you are an automaton, you cannot use a brain, you will do it the way we say. Where with life insurance, the good and the bad is that you can use a brain. You can actually use that brain that God gave you to actually use it for creative ways or any way you want. So for example, with my kids, I don't have to worry about predicting the future about whether they go to college or not. Or like with my oldest daughter right now, she got a scholarship and then she got financial aid, like a Pell Grant, that covered all of her tuition anyways. If I had tens of thousands of dollars sitting in a 529 plan, I couldn't use it for her. And so it would be a waste. I would have to pull it out and then I get penalized on my own money. That's ridiculous. I can use my policy. I can use that cash in there with no penalties, no taxes, no issues. The only thing they will charge me if I borrow from it at least, and I can withdraw money, but if I borrow from it, they charge interest, right? And I can pay it back however, whenever I want. So I can use it for education, and if they don't go to college, guess what? I can still use it for something else. I can give it to them as a gift later on. By the way, you can get policies on your kids. You control the money, you own the policy, and later on when they're adults, it's your choice whether you want to turn it over to them or not. They don't even have to know about it. You can literally keep it on them for the rest of your life, or you could say, maybe when they're in their mid to late 20s, when they start to, their brain snaps and start forming together and they start having, like real thoughts again, versus the teenage hormones driving them crazy. You can then say, hey, you know what? I know you're starting out life. Maybe you want to get a new home. Here's some money that I built up in this account. By the way, I invested with it, which was kind of cool. Thanks for letting me use it. And then guess what? You can use this money now to get your first home. Or maybe this is to get you your start for starting a family or whatever it might be. Those kind of things is really great that you can use for that. I can use it for retirement, but I can retire early with this. Rather than wait until 59 and a half with the IRAs and 401ks, and if you try to use it earlier, you get slapped with penalties, I can use it to retire in my 30s and have tax-free retirement income, quote-unquote retirement income, whenever I want. The thing I love about it too is that I not only can use it for that and use it as emergency reserves, which by the way, also in most states it's 100% protected from lawsuits and creditors. Somebody sues me and wins, I can have millions of dollars stored here and they can't touch it. They cannot get to it. But at the same time, I can also use it as an asset. I can qualify for loans and mortgages and all kinds of stuff. I can use it as collateral. Did you know Walt Disney actually used his life insurance policy as collateral so ABC would come in with the rest of the money to build Disneyland? He literally used his policy, the cash in there, as collateral for Disneyland to create the happiest place on earth where you get to wait in line for an hour and a half and smile about it, right? You're welcome. You also have like Ray Kroc. He started McDonald's, used his policy by paying his executives salaries with it. I mean, we've got people like Pampered Chef. You ever use Pampered Chef? The seed money came from her policy. So it's a great way to start. By the way, any interest you do pay, if it's for business purposes, you write off the interest too. So you get to do that. When I invest with it in real estate, any tax benefits I get, I keep all the tax benefits. Or if I used an IRA, I would lose all my tax benefits by putting in that IRA. I would have to pay taxes on something that I might have get tax benefits before. So I can use it for those kind of things. I can use it for whatever I want. That's the main pro I see with it. And yes, I can even make money in two places at once by investing that money for cash flow, using that money at cash flow to pay back down the loans to save on interest. But then the period of time, the whole cash that's in here, they're paying me 6% tax-free interest right now. So I'm making 6% over here. I'm paying down the loan with the cash flow. I could be earning 10, 12+% on and paying that loan down. I'm actually making money in two places at once by doing that. That's some of the best things. But again, I think the biggest factor for making sure that this works is how do you lower the costs? And that's where, if you haven't subscribed to our channel, do so today. There's plenty of other infinite banking videos, but there are great ways to be able to save on those costs so that you're not paying just all this insurance costs and agent commissions and stuff like that just to pay for their family. No, prioritize your family first by lowering those costs and getting the max ROI possible. If you want to learn more about max ROI infinite banking, go to our website, moneyripples.com. There's a whole section on it. You can dig in deeper there.